What's the most effective way to build up your retirement savings? Well, this is important for everybody, but I most often run into it with people who feel like they're behind and they want to catch up on retirement readiness. Let's look at what has the biggest impact on your retirement success. And we're going to look at a couple of different things, but we're primarily going to focus on this question of saving more each month or each year versus investing more aggressively, and what's going to have the biggest impact. There are essentially two ways to build up your account balances. You can add more to those accounts or you can grow the assets that you already have. Some people have plenty of cash flow available. There's no problem adding to those accounts, and other people have a lot of time, so they can let time and compounding do their thing and help them build up their account balances. But I occasionally talk to people who are near retirement. They only have, let's say, 5 or 10 years, and they're wondering what they can do to improve their chances of success. These people might have started saving later in life, or maybe they hit some speed bumps and they're getting back on track. Regardless of the cause, they might say something like, I feel like I'm behind and I want to get really aggressive to catch up. When I ask what they mean by getting aggressive, because maybe they mean they want to save a high portion of their salary, for example, they almost always respond that they want to invest aggressively in the markets. So take a lot of risk and hopefully earn higher returns that will boost their account balances. That philosophy makes me a little uncomfortable, but sometimes it is the right approach. So let's really dig into some numbers here and get some insight on how it looks if you do that and maybe what an alternative or two might be. Let's start with an example where you save $10,000 each year and you earn 6% on your investments. And of course, your numbers might be very different. So you can get your own numbers with a calculator here that I'm using. I'm going to have a link to it in the description, along with some more general retirement planning information that I think everybody needs to know. So again, the specifics here are less important than understanding the concept. And the impact should really be very similar, even if you use different numbers. So in our example, you increase your contributions each year with inflation. We're saying 3% here, and you have 10, 20, or 30 years to go until retirement. So let's assume you have a magic wand and you can double the amount you save, or you can double your investment return, or both. For now, we're assuming you start with 0, or we're just looking at what happens with any future contributions, and we'll look at some existing balances later. So let's see what happens when you change those numbers. Let's go with saving $20,000 per year, or double your current savings. That's easier said than done, I know, and I want to acknowledge that there are some challenges here. If you double the amount you're putting in each year, you're effectively going to double what you end up with. That makes sense, and it's certainly helpful to have twice as much money at retirement. In the example with $10,000, you would have ended up with about $149,000 given those baseline assumptions. Again, $10,000 a year, 6% return. But if you double the amount you're saving, you end up with nearly $300,000, which is a nice difference. Now, let's assume you could double your investment return. So instead of earning that 6% per year, you're going to earn 12% per year. And this is tricky because by increasing your risk, you don't automatically increase your returns. And we can't ignore downside risk as we pursue the potential benefits of risk. So you might expect to have higher returns over the long term, but the fact is you might also experience bigger losses. You might not ever be able to recover from those losses or not recover quickly enough, so it's a risky approach. For example, we can look at historical market crashes and see what different investors might have experienced. Switching from a lower risk portfolio to a higher risk strategy certainly makes a difference there. So we'll just assume that you go from a portfolio of 50% stocks and 50% bonds to a 100% stock portfolio. Now, a 100% stock portfolio might not even produce the types of returns we're playing with here. So you didn't necessarily double your returns by doubling your stock exposure, at least when we look at the long-term historical data. So according to a Vanguard analysis here, the increase was roughly 2% per year. So we're not talking about going from 6 to 12. We're talking about adding about 2%. And again, let's not ignore that risk. So during the great financial crisis a 50-50 portfolio might have lost roughly 22%, versus a 100% stock portfolio might have lost roughly 44%. So that's a nice clean double there. During the dot-com crash, 50-50 portfolio might have lost about 13%. 100% stock portfolio might have lost about 43%. So, of course, during strong markets, the effect is much better and you can get some good growth. But the problem is you just don't know what you're going to get. Going back to our numbers here, it turns out that it's kind of hard to invest your way out of a savings challenge. So again, a 12% return is a relatively high number. I'm generally not comfortable using a number that high when I do retirement projections for clients, but my crystal ball's broken and anything's possible. And many of you don't have 30 years till retirement. But if we go with that 12%, just to illustrate the point, we can take the 10-year period, for example, and again, at the baseline, you would have been at around 150,000. And if you are just able to double your returns, you end up with about 195,000. So that is an increase. It's a nice increase, but it's not a huge increase. You might expect a bigger difference if you say, what if I can double my returns over the next 10 years leading up to retirement? Looking at the 20-year period, we do see things starting to get closer. So again, at the baseline, you had 467,000 at retirement. By doubling your savings alone, you'd have 934K. Or if you double your returns without doubling the savings, you get fairly close at 871,000 at retirement. So with a longer time period, we can see how time and compounding really start to work, and it gets you closer to having the same effect as doubling your savings. It's not until we have a 30-year period in this example that you really get a lot of juice out of doubling the investment return. So that ends up being more effective in growing your accounts by about $800,000, just eyeballing that. That's more effective than just doubling your contribution. So essentially, if you have a lot of time, you're going to get the best bang for your buck by earning more. And of course, you have risk and you're going to have more ups and downs and more volatility. But if you can ride that out, then it may pay off for you. Versus in those shorter time periods, doubling your investment return doesn't seem to be as effective as actually saving more each year. And again, it's easier said than done to just save a lot more money. Of course, on the bottom line here, we've got the combination of saving more and earning more. That's great if that works out for you. And of course, it's going to magnify the effects and you'd end up with more money at retirement. Now, many of you don't have 30 years until retirement and you're not starting from zero. So you might still gravitate toward that idea that taking more risk is the best way to catch up on retirement goals. And it's true that, bigger investment returns can potentially produce dramatic results, especially over the long term. So let's look at what happens when you dial up the risk on an existing portfolio. And you might think that I'm always saying that risk is bad and you should not attempt to take more risk. That's not the case. I just want you to be sure you understand what the pros and cons are and then understand your rationale for taking more risk and decide if that makes sense. I sometimes like to walk through some optimistic and pessimistic scenarios with clients. So let's say you have $400,000 today, and if you could double that within a couple of years, that would give you $800,000, which is enough to supplement your Social Security and you can live comfortably. If that's how things work out for you, that's great. That's exactly what I would want for you. But it's also possible that your investments could lose value. So let's say things go down to 250,000 instead of going up to 800,000. Well, 250,000 is still a lot more than some people have, but it doesn't look as good as your 400,000 looked. That type of a decline is very realistic with a portfolio that has heavy exposure to stocks. So in a case like that, you might have taken a situation that was kind of workable and things have gotten significantly more challenging. The amount of income you can take is roughly half, and every withdrawal you take takes a bigger bite out of your portfolio. But let's do a less extreme example. So we'll say you have $1 million, just a nice round number, and you want to have substantially more in 4 to 5 years. If we go back to that example of saving an extra $10,000 per year, that's going to be roughly $50,000 over the next 5 years if you do $10,000 a year for 5 years plus any growth on that money. That doesn't really make a big dent in your portfolio. It is roughly the same as adding about 1% in investment returns, but this might not get you exactly where you want to be. So again, we'll look at some optimistic and pessimistic scenarios. Let's assume that you could earn an extra 3% per year by taking on more risk, and we'll ignore future contributions. So again, remember that the historical long-term effect of going from a 50-50 portfolio to 100% stock was roughly 2% per year, and we're talking about 3% here. So after 5 years, your $1 million nest egg might grow, assuming flatline growth, which is unrealistic. It might grow with a 6% return. You would have had 1.3 million. But if you can get that 9% return, you would end up with about 1.5 million. So that's a difference of about $200,000. While rules of thumb are highly problematic, the so-called 4% rule can provide a quick estimate of the impact of that. So, for example, what's the difference in your income with an extra $200,000 in assets? Well, you might expect to pay yourself an extra $8,000 per year or $667 per month. That's not too shabby. But what if things don't go your way? So the additional risk required for that 9% return might mean that market crashes are more severe by 20%, 30%, or more. And without getting into complicated math, the result could be living with $8,000 per year less than you would have been able to pay yourself. And the actual difference is probably bigger than that. Of course, if you can ride out the downturns and if you're fortunate enough to have the market recover when you need it to, things might work reasonably well, but you might not benefit by much. That's if you come out ahead at all, and the ride could be stressful. To illustrate that point, we can look at some actual returns from 1950 to the end of 2023. That 50-50 portfolio is the blue color, and then you've got, I guess, the aqua is 100% stock. And over 5-year rolling periods, again, over 1 year, anything could happen. It's essentially like gambling, and there's a lot of risk, especially going to 100% stock. But over 5-year historic rolling periods, you tend to level things out a little bit, and you can look at how the 50-50 portfolio, the worst case was about 1%, the best case about 21%, versus the 100% stock portfolio, worst case -3, best case about 28. I'm not sure I'm seeing a lot of benefit in there in terms of the extra risk you might take. 5 years is a relatively short time frame when we're talking about investment timelines. So, I don't know. This is all historical data. It does not predict the future. Things may be very different, etc. But these are just all things to consider. So what is the potential benefit you could get? What are the risks? And what are you going to do if things go sideways? And I guess another important factor is how well are you going to sleep at night if you go from a portfolio that is broadly diversified, and let's call it moderate, just as a general description, to a portfolio that is 100% stocks, because it's probably going to be a bumpier ride. Again, I'm not saying don't increase your risk, because, if you are currently taking less risk than you maybe could or should, then it is important to evaluate that question. It might be the case that maybe you have too much in cash and safe assets, and it could potentially benefit you to add a little bit of risk intelligently, because if you are too conservative, there is some risk of losing purchasing power over the long term to inflation. So that was a deep dive on saving more versus investing. What are some other strategies you can think about if you want to catch up on retirement? Well, downsizing or relocating is obviously a big one that can bring significant savings. So lower housing costs, not to mention getting any cash out from a home sale, if that's in the cards for you. Lower housing costs can make things a lot easier. And if you can't do anything right now, maybe you can make some changes in the future. For example, could you relocate after you stop working? Whether that's to a totally different geographic area or it's just to a smaller, less expensive place that might be farther away from where you work. You could also consider part-time work or consulting or some other way to get income. And yeah, that's not your first choice, and it's certainly not retirement per se, but it is an effective way to change your working reality sooner than later. So if you completely turn off your income, that's one thing. But if you can get some part-time income for a number of years, that's a really powerful strategy for your finances. You don't need to necessarily earn nearly as much as you're earning today, as long as you can get something coming in, which slows down or delays withdrawals from your savings. I think you also want to make a plan because you might not be as far behind as you might think. So if you run some numbers and really get detailed with things and even incorporate how spending really happens in retirement, because retirees don't necessarily spend in the same way as pre-retirees, you might find some hope and encouragement that you can retire sooner than you think. So I hope you found that helpful. If you did, please leave a quick thumbs up. Thank you and take care.